Hello, and welcome to today's webinar on estate and gift tax exemption and planning for the exemption. I hope everyone is doing well, and I thank you for joining. My name is Aaron Sherbin. I'm a partner at Jaffe, Hewer & Weiss and head of our estate planning, wealth and transfer group. And joined with me today is my partner, Bill Sider, who's a member of our tax planning group.
Welcome.
Before we get started, I want to go through a couple of housekeeping items. First of all, I should point out that your audio will be turned off during the entire presentation so that we can prevent any potential background noise. There will be a time at the end of the session to answer questions and comments. So I encourage you to use the Q&A button and submit your questions. Again, we will be having time at the end of the session to answer those questions. And also, I just want to point out that during the session, we'll be asking a couple of polling questions. A dialog box will pop up on your screen and present you with a multiple choice question. We'd really like your feedback, and so we highly encourage you to answer those poll questions for us. Today's agenda will be, first, we're going to briefly outline the current estate and gift tax law environment, and also then discuss what potential legislative changes we see happening with the estate and gift tax. After we sort of lay out that kind of framework, we'll then go on to discuss some of the planning strategies that we're currently advising clients to consider to take advantage of the current estate and gift tax exemption amount before the laws change. We'll also talk about some of the issues you need to consider in order to pick the right strategy for you. There's a lot of factors and considerations that need to go in to picking the right strategy, and we'll be sure to address some of those issues in this presentation. And then, as I mentioned, at the end of the presentation that Bill and I have, we'll provide a period of time where we can answer your questions. So here's the first polling question. When was the last time you reviewed and updated your estate plan? And here's the dialog box. I'm particularly interested in the responses to this question. During the lockdown, I saw an increased intention by clients with regard to their estate plan. I think during the time off, clients were reflective about their estate plan and concerned about the what ifs. And so they were revisiting their estate plans. I was certainly talking with a lot of clients during that time about updates to their estate plan. All right, so good news is that a majority of you have revisited your estate plan within the last 1 to 5 years. I guess the point here is that the takeaway is that you should be periodically reviewing your estate plan to make sure that it considers the current circumstances, the current environment with you and your family, as well as taking into account the tax law changes. So thank you for weighing in on that. So now I'd like to turn it over to my partner, Bill Sider, who will discuss the current estate tax and gift tax law environment, and also discuss what he sees as the potential changes that might occur in the future. Bill, take it away.
Thank you, Aaron. So there are 6 critical items that everyone on this call needs to be aware of that I'd like to spend a few minutes outlining. The first, when we talk about exemptions, what are we really thinking about? And everyone needs to understand that under current US tax laws, there is a tax on the transfer of property from one person to another. The exemption that indeed is the topic of our discussion today is an amount that, provided transfers dispose of property that is less than the exemption amount, then there is no tax that's levied. So very simply, the goal here is to make full use of the exemption before any transfer tax is imposed. So that's number one. Number two is to recognize that the current exemption is unified. What I mean by that is that there is a transfer tax both on lifetime transfers for gifts, as well as transfers that occur as a result of death. So we've got the gift tax and the estate tax working in tandem with one another. This is generally referred to as a unified credit or a unified exemption. The third item that's important to realize about the exemptions is that they are currently at an all-time historic high-level watermark. And that's really a critical item to keep in mind. So brief history, up until the recent Tax Cuts and Jobs Act, which was put into place effectively January 1 of 2018, the exemption amounts were roughly $5.5 million for an individual and 11 for a married couple. As you can see from the table in the slide below, these amounts are now double. The additional sums are the result of inflation increases. And what this means is that an individual can pass, again, either during life or at death, roughly 11.6 million of property without incurring any tax, or a married couple can transfer $23 million of property. The next item, the fourth critical point to remember when talking about exemptions, is that these current high water marks are due to sunset. As a result of the TCJA legislation, they will return to their pre-2018 levels roughly 5 years from now at the end of 2025. So everyone should be aware that this historically high level of exemption is intended to scale back, to spring to where it was back in 2017, which again is roughly 5.5 per individual or 11 per married couple. The fifth item to keep in mind is that assuming you take full advantage of them and the law swings back to its earlier reduced exemption amounts, there's no bait and switch going on here. The IRS has made it very clear that if you fully utilize your $23 million exemption in the case of a married couple, once it goes back to the lower amount, say 11 million, then there's no penalty that may be taken against you on your estate tax. So the action item here is to think about whether some action is required before the scale back happens. The final item is, what is the tax rate if you exceed the exemption amounts? And that is currently at a 40% level. So with that background on what the current scheme is, I'd like now to go to the next slide to talk about what's proposed by the two candidates. Under a President Trump, the recent changes whereby the exemption amounts were made to their current historic high levels will be made permanent. In contrast, Vice President Biden has made several proposals with respect to both the exemption and other aspects of estate planning. First, he would propose that the exemption amounts go back to their 2009 levels, which, as you can see from the chart, was for the estate tax, $3.5 million per individual, or double that, $7 million for a married couple, and delink the unified nature of the exemption so that in the case of transfers during your life, the exemption amount wouldn't be 3.5, but rather $1 million, so that there would be a incentive or lack of incentive for sort of giving during lifetime. He would also increase the tax rate up to 45%. So this is a dramatic change that has been proposed. If we're looking at a married couple, a exemption amount of $7 million under a Biden plan, as opposed to what's currently in place, $23 million, which is a $16 million difference. If you apply a 40% or 45% tax rate, that's in excess of $6.5 million. A Biden plan would also dramatically change the estate planning landscape by eliminating the step up in basis at death. Let me talk for just a quick moment what that is in case you're not familiar. Under current law, which has been on the books for decades, when somebody dies, any appreciated property they have is stepped up to the fair market value of that property at death. So to take a simple example, if you bought Apple stock back in 2005 for $100 and passed away this past year where it was worth $1,000, then at your death, your heirs will take it with that new basis at its fair market value of $1,000. In other words, that $900 built-in appreciation is not going to be subject to any tax whatsoever. Vice President Biden's plan would reverse that, and it's not exactly clear how mechanically that would occur. One idea is that there would be immediate tax to be paid at death. In my example, that's $900. In yet another mechanism, rather than a step up, the heirs would take the carryover basis. So in my example, the heirs would step into the shoes of the decedent, taking a $100 basis, thereby preserving that $900 gain for future recognition. The final item that's really relevant on a Biden tax plan is the elimination of the capital gains preference for income above $1 million. Currently, as most people probably know, the capital gains rate is preferred to ordinary income. It's only taxed at a 20% as opposed to a 37% rate. The Biden plan talks about the increase of capital gain, roughly doubling it up to a 39.6% level. And that would be a dramatic change, which of course, integrated with the step up in basis eliminations, could produce substantial amounts of tax associated with a decedent's death.
So Bill, I got to ask a question. How likely are these changes to occur?
So great question, Aaron. Of course, most of us are focused on the presidential race, and my crystal ball isn't any shinier than any of you out there. But suffice to say, even if Vice President Biden wins the presidency, he's only really going to be able to enact legislation if he also has a democratically controlled Congress. And that will require at least a change of 3 seats to get a Democratic majority in the Senate. So when talking about the likelihood of these changes, there's really the 2 issues of who's going to win the White House and who's going to really take control of the Senate.
So assuming that there are some changes next year, whoever gets into office, whoever takes control of Congress, could that legislation have retroactive effect to this year? If it's in the middle of next year, could it have retroactive effect to January 1? How does that work?
Great question. So when we talk about retroactive taxes, it's a rarity, but it can occur. I would say that changes that would reach back to the current 2020 year are unlikely, but changes that might reach back to January 1 of next year may be possible. Vice President Biden has made it clear that he wants to eliminate the exemption amounts effective day 1, Whether that translates to January 1 remains to be seen, but there is historic precedent. When Bill Clinton took the White House in 1993, it took him until August in order to finalize tax legislation, but once finalized, that legislation was effective 8 months earlier on January 1, and the material changes in that legislation were to increase tax rates, not dissimilar to what Vice President Biden is proposing now.
Okay, great. So for me, the takeaways are, number one, the tax savings are significant. You mentioned there could be a tax savings in excess of $6.5 million. I would also point out that it could be even more if you take into account future appreciation that would occur on those assets that you would be employing in one of these strategies. So that's one thing to take away. The other is that we really should be acting now, this year. We shouldn't wait till next year, even before inauguration, for fear of potential retroactive effect. So with that in mind, what are the planning strategies we recommend? We see the next slide. So we're going to talk about three strategies. One is the Spousal Lifetime Access Trust, commonly referred to as a SLAT. The second is a Completed Gift Domestic Asset Protection Trust, or commonly referred to ADAPT. And then finally, an estate tax freeze technique of partnership, LLC, and or closely held C corporation interests. So the first strategy, the SLAT. So under this strategy, a client would be transferring assets by way of a completed gift to an irrevocable trust for gift tax and estate tax purposes, and naming his or her spouse and descendants as the beneficiary. The trust would be taxed as a grantor trust for income tax purposes, and we'll get into what sort of ramifications that has when we talk about the issues. And it's also important to point out that in this type of strategy, it's important that you have an independent trustee who's given the discretion to distribute assets.
Aaron, you mentioned the need for an independent trustee. Is it possible for the spouse to him or herself serve as a co-trustee?
It is, but I don't recommend the spouse be the sole trustee. If the client is interested in having the spouse as a co-trustee with an independent trustee, I think that works. You have to be careful about what sorts of distribution standard your trust has, and if that distribution standard is going to be applied to the spouse. You're probably best providing that the independent trustee exercise that power of distribution and not the spouse.
And assuming the spouse does get a distribution, what are the estate or gift tax consequences of that?
Good question. So, look, the whole purpose of a planning technique like this is to make sure that we're getting assets out of the estate and free from estate tax. Certainly, we have a spouse named as a beneficiary so that he or she can have access to it as a beneficiary, and then in an indirect way, allow for the spouse, the other spouse, to have access through that beneficiary spouse. But remember, when you're taking assets out of this trust, you're putting them back into your estate. And so you're sort of effectively undoing the tax planning of getting it out of your estate. Again, we want to be able to give the spouse the access to the assets, but it would really be a trust of last resort. The client should really be looking to sources of wealth and income from other sources, particularly assets that are in their estate rather than this trust. The second planning strategy is a domestic asset protection trust. And this is a strategy that is an extension of an asset protection trust that has been sanctioned and legislated in the state of Michigan. Michigan, along with approximately 18 other states, allows for a domestic asset protection trust to be created. And again, these were typically used for asset protection. And when you created the trust, it's a self-settled trust, meaning you create this irrevocable trust and name yourself along with your spouse and descendants as beneficiaries. So unlike the SLAT, the client or the grantor or creator of the trust is also a beneficiary. In this case, unlike its traditional use as an asset protection trust, what we do here is we have the client make a completed gift to the trust. And so effectively removing the assets out of the estate. It's an irrevocable trust like the SLAT. It's also a grantor trust for income tax purposes. The thing to point out here, most importantly, one of the big differentiators between this strategy and a SLAT is that you must have a Michigan resident as your trustee.
Aaron, I understand the parallelism to the SLAT, the opportunity of the grantor to get back certain funds that have been contributed. I'm curious if you could comment on the standards by which a grantor can get back a distribution, especially with having an independent trustee.
Yeah, so with this technique, this strategy, you have, in order for it to work, in order for the gift to be a completed gift to a trust of which you are naming yourself as a beneficiary, is you have to give the trustee an absolute and pure discretion standard. It can't be based on what we call a HEM standard, health, education, maintenance of support, or even a more broader standard based off of HEMS. It's got to be pure, absolute, and sole discretion of the trustee. And that may cause some concern for clients, and I understand that. What I would say is, along with this strategy, what we try to build into the trust is giving the client, the grantor, if you will, a power to remove and replace the trustee, so that the client has some comfort that if they become at odds with the trustee or the trustee is not working out, they have that ability to remove or replace him or her. So, you know, when we pick out strategies, sometimes, and you mentioned step up in basis and some other factors that are important in the process. In other words, we're not only doing estate tax planning here, but we have to be mindful of the income tax planning. And so what I'd like to do now is to turn it over to Bill, who will address some more complicated, sophisticated type assets and how there may be a strategy that incorporates both estate planning and income tax planning at both.
Thanks, Aaron. So an estate freeze can be implemented with respect to a closely held business, whether it's a partnership, an LLC, or a C corporation. The goals here are really twofold. One, as you have been illustrating, Aaron, to try and remove property from the estate of a grantor, or at least to freeze the existing value so that future appreciation will inure to the benefit of younger generation. And at the same time, this particular strategy appeals to businesses where the grantor has a highly appreciated stock or LLC interest. In my example earlier on in this presentation, I used a $900 difference, but in some businesses, in particular those involving real estate, where we've gotten the benefit of depreciation and interest deductions, grantors may have what's referred to as a negative tax capital account that is in the millions of dollars. I've been seeing over the last few months some tax returns that show a $50 to $100 million negative capital account. And were you to transfer this interest to a younger generation to get the asset out of the estate of the grantor, then capital gains tax would be owed on that transfer. So the idea of an estate freeze, as the name suggests, is one which does not trigger a transfer. In other words, that enormous gain that I spoke about is not triggered, but at the same time allows the future appreciation to pass to the next generation, thereby insulating or freezing the amount of the current estate tax. So implementing this strategy begins with typically a recapitalization of either a existing entity or a new entity into common and preferred interests. Next slide, please. Once this recapitalization is done, the idea is for the grantor to continue to own the preferred partnership interest, which will have a set fixed value, thereby essentially freezing their negative capital account. And the common shares will carry the opportunity for future benefits, thus passing the appreciation to the next generation. Now, the underlying concept here with the grantor's deep negative tax capital account is that the grantor would hold this interest until his or her death. If you were paying attention earlier in this presentation, you might say, well, Bill, that time-honored notion of a step up in basis may be going away. So be mindful of that possibility. The second aspect, as I said, is that due to the recapitalization, the future earnings of this business, the additional appreciation, will be lopsided, while a grantor holding the preferred interests will get some benefits. The lion's share will be passed to the common holders, which would be presumably younger generation family members. And then the third advantage is, in many cases, especially if we're recapitalizing a real estate business, what the grantor may prefer is a set annuity type payment, and that can be easily accomplished with this strategy. As you remarked, Aaron, this is a unique strategy, one that is specific to facts that may or may not exist, but it does provide a sort of win-win situation for the client that's anxious about potential capital gains taxes.
Yeah, Bill, you know, what I don't want to get lost in this discussion is the fact that at some point, if you employ one of these strategies, you have to file a gift tax return. And you've got to be able to provide for the value of the gift at its fair market value at the time of the gift on that estate tax return. And particularly in your strategy where you're talking about closely held business interest or real estate deals, valuations may be tough, and you may even have to employ a valuation expert in order to have that done so you can report it properly on the estate tax return or gift tax return, excuse me. Any idea how long it's taking, and how do we calculate the turnaround time on evaluation for these strategies?
Yeah, so it's a great point, and a couple items. First, on this particular strategy, the close involvement of a expert in appraisals is absolutely required. There's some nuances here regarding the value of the preferred interest that are absolutely essential. But your broader question is really a segue back to the point we were making earlier, which is many folks ought to think seriously about contemplating transfers now in the light of potential changes. And on that point, it is commonplace for assets to be valued by an independent party when you file a gift tax return. And as you well know, over the last few months, while we as lawyers have seen a ramp up in activity, those in the appraisal field are absolutely inundated with work. The takeaway here is that an understanding of the full process associated with implementing one of these strategies, which involves obviously work with lawyers, work with accountants, work with valuation professionals, critical to start that sooner than later. To your specific question, I'm seeing wait times of anywhere from 2 to 4 weeks at this juncture from valuation firms.
Okay. Thanks. So I think we're going to have another polling question. Here we go. What is your most important planning goal? If you would take a few moments to answer this question, we would appreciate it. And I guess my point here is while we're asking you to pick one, I don't necessarily think that these goals are mutually exclusive. I'll give it a few more seconds. So it's interesting, the predominant answer was wealth preservation, followed by tax savings. I guess the takeaway here, what I would say is that whenever you're doing your estate and income tax planning, you really should address all of these factors. A comprehensive plan will take into account each of these goals and objectives in developing the right kind of plan for you. So thank you for answering that question. So, Bill, we've talked about some 3 effective estate planning strategies to take advantage of the exemption amount as it currently exists. Obviously, picking the best strategy for the client is dependent upon, addressing a number of different issues. And what we've done here on the slide, as you can see, is lay out for you a few of those issues we typically consider when we're trying to develop the right kind of strategy for the client. Bill, I'm going to pick out a couple, 3 of the issues that I see that are most important. I'd like you to do the same. For me, the biggest issue with the SLAT strategy is the reciprocal trust doctrine. And that is a doctrine that is imposed by the IRS. It's sort of along the lines of substance over form, form over substance type of argument. As you can imagine, if you've got a husband and a wife, each creating a SLAT for the benefit of the other and kids, it looks as if they're simply crossing over assets and just simply moving assets from themselves to their spouse and vice versa. And the IRS is mindful of that, quite frankly, and has imposed this reciprocal trust doctrine. So the workaround that we have to consider is if we're going to do two slats, one for husband and one for wife, we've got to make sure that those trust documents are different in substance, that they've got different provisions, that maybe they have different trustees, different beneficiaries, and most importantly, that they're executed at different times and not together. So that would be one issue that should be highly considered if you're, considering a SLAT. The other one is this grantor trust status for income tax purposes. What I want to point out here is that both the SLAT and the DAPT are grantor trust for income tax purposes, meaning that the client, the grantor, has to pay the income tax on whatever is earned by that trust. And the client may say, well, wait a second. I'm moving all these assets out of my estate into a trust for the benefit of others. I've got to pay the tax on the income. Well, the answer is, wait a second, it may not be such a bad thing, because by the client paying the taxes, they're effectively reducing their estate further by the tax that they're paying, and they're allowing assets that are outside their estate to grow tax-free. It's what we call as a tax burn, and may provide additional tax planning and benefits to the client. And I would also point out that these documents do provide that the client can be reimbursed for those taxes. So if for some reason they're not comfortable paying the taxes with other assets, they can reach the assets of the trust and be reimbursed. I'll turn it over to you, Bill, to raise some of your issues.
Sure. I know we want to have some time for Q&A, so I'll just throw out a couple real quickly, which is the carryover basis versus the step up, and also the generation skipping transfer tax. As you've heard us speak, while the headline item is certainly about the potential reduction in exemptions, to really implement the right strategy for a client, you need to look at the complete picture. You need to look not only at the estate tax, but also the income tax issues associated with carryover or a step up in basis. You also need to focus on the generation skipping transfer tax, which is yet another type of levy beyond estate, beyond gift, beyond income tax that imposes a transfer from grandparents to grandchildren or further descendants. So the point being, whatever strategy you implement, it needs to be a comprehensive package to focus on all of these different elements to figure out the unique strategy that will best suit a client and their family.
Great. All right, so now I'd like to open it up to questions and answers. Bill, one of the first questions I received was, I'm a single individual, I'm not married, but have children. Is there a planning strategy technique that I can utilize? And if you don't mind, I'll take that one. And the answer is yes. In fact, I think the DAPT strategy is an excellent one for a single taxpayer who is not married but still wants to be able to move assets out of his or her estate and benefit him or herself and the family. Again, the DAPT would allow for the client to name himself or herself as a beneficiary, along with with descendants, and effectively move assets out of his or her estate. Here's another question. I'll turn this over to you, Bill. What's the difference of wealth versus asset protection?
Sure. So when we talk about asset protection, generally speaking, there is some concern regarding a grantor's potential contingent liabilities. So if you were involved in a profession that had high issues associated of liability, whether it's a physician, potentially a financial advisor, then in addition to, of course, acquiring an appropriate amount of malpractice insurance, you might have as a goal what's referred to as asset protection. And as you heard Aaron describe earlier, while we're using the DAPT as an estate strategy, the original design of a DAPT was to shield the grantor's assets from creditors, which is a terrific device, adding another layer of liability insulation. When we talk about wealth transfer, typically what most folks mean with that notion is that the family has accumulated, usually during the first generation, substantial wealth, whether it's in the form of liquid assets or more generally in the case of a business interest, oftentimes locked within an existing LLC or a corporation. And the goal would be to carry that wealth forward to the next generation. Here, most folks are mindful of the current estate and gift tax landscape, which, depending upon the level of the exemption, could take a sizable dent out of that family wealth. Hence, part of the planning, obviously, that we've talked about today, to strategize on mitigation techniques for limiting the tax to preserve that family wealth.
Okay. Here's the next question. If I utilize a spousal lifetime access trust and provide for my spouse and descendants to be beneficiary, what happens when my spouse dies or if we get divorced? Excellent question. And that's one of the risks and factors we have to consider when talking about or recommending a spousal lifetime access trust as a technique. The notion of the SLAT is that the client would be able to have indirect access to the assets through their spouse as a beneficiary. Of course, that indirect access no longer exists if they become divorced or the spouse dies. So one of the workarounds to that issue is that the client is given the right to borrow against the assets. And in fact, as we talked about the SLAT being a grantor trust for income tax purposes, one of the reasons it is a grantor trust is because the trustee gives the grantor the power to borrow assets from the trust. So in that situation, one of the potential workarounds, if you get divorced or the spouse dies, would be for the client to be able to borrow assets against the trust. I think that's it for questions, Bill. I don't know if you have any concluding remarks or issues you want to raise before we go.
My only concluding remark is really to communicate a sense of urgency. It may be the case that after reflection, you decide not to do anything at all, but you certainly don't want to be in a situation Q1 or Q2 next year wishing that you had spent some time thinking about your estate, thinking about your desires on who should get your property, contemplating the tax effects, both under current law, future law, figuring out what would make sense. The time you spend doing that now, I believe, is going to pay significant dividends in the future.
Great. Thank you. Well, we want to thank you for joining us. In closing, if we were not able to get to your specific question, or you want to talk to us about your unique or specific situation and want to get some personal one-on-one guidance, you can certainly reach out to Bill or myself directly. Either call us or reach us by email. Today's slides will be provided to you shortly after we conclude. So you'll be able to have those slides for print if you would like. We'll also be recorded. We've also recorded this webinar, and it will be available on demand within a few days at our website. And you'll also receive a survey, and we really encourage you to fill the survey out. We really want your feedback. We highly encourage it. It helps us improve upon our webinars and also helps us determine what other sorts of topics may be of interest to you. So please take the time to fill out the survey and return it. We also have some additional fall webinars scheduled, and we'd love for you to join us at those. They will be addressing some family law issues and cybersecurity issues, which may be of benefit to you. And so we encourage you to watch those, and you can find those at our Jaffe Law website under the webinars tab. We have some resources available. I know we've talked a lot today about the SLAT and DAP strategies. If you go to our website, you'll be able to find a couple of alerts we've done on those topics, and feel free to print those and share them with people you know who may be interested in these techniques. And here finally is our contact information. Again, feel free to reach out to Bill and myself with any questions or concerns you have. Be happy to talk to you more in depth about these strategies and what may work for you and your family. And again, we thank you for joining, and we hope that you found this webinar informative and helpful. Thank you.
Bye-bye now.